Hello, hello, welcome to the Closing Beat. How you doing today? All is good, I hope, with you out there. We are financial advisors here at Jazz Wealth. You know the drill, right? JazzWealth.com, subscribe, all that good stuff. I just like coming here and teaching, helping you guys out with understanding the market. We got a lot of data here today, so we're going to cover that. And it is official, what you see at the bottom there. We are the only advisors that could possibly be wearing no pants, and you would have no idea, right? Imagine that. You go see your advisor, he's got a suit and tie on, but like not the bottom part of the suit. Okay. Anyways, let's talk about the stock market here today. We got the Fed president speaking earlier today. It was like bright early today. He was up and at it. We got inflation numbers coming out on Thursday. I thought it was Wednesday for the longest day, but tomorrow's Wednesday. And then earnings start on Friday. We talked about that yesterday there. Did a little bit of a deep dive into inflation, and I am sticking with my guess. I didn't see many guesses from you guys. What do you think the headline inflation number is going to be year over year? I'm going to go with 6.45% year over year for the headline inflation numbers. And the focus lately has been on core CPI, because you're taking out energy and food, and they say, you know, the things that are more volatile, right? And energy's been more volatile, so I'll give you that. But the benefit to that is we can use outside data to determine whether the core CPI number is going to be up or down. So I'm going to tell you it's going to be down just a little bit, but it's going to be down. And so how do we come up with that? Let's just jump over here. Let's do something real quick. You want to go over here? There you go. So if you look at core CPI, there's a weighting inside of it, and 5% of core CPI is made up of new car sales. 5% is made up of used car sales. So we can use like J.D. Power and Associates data. Car Gurus makes their data public. Manheim Auction makes theirs public. And of course, there's the normal PCE number that comes out, I think it was last week. Anyways, so if we look back over history and just plot all the most current data with everything in history there, we can see that used and new cars are actually declining there, in particular used cars. For new cars, we could tell where the prices are coming down because over here on the left, if you want to take a look, new car dealer incentives. Things that they'll give you to get in to come into the store, those are starting to increase. So we know that new car and used car prices have and are coming down. So we could take that data and say, well, 10% of the core CPI number should be less than expected, or less than it was before, right? Less than a year ago. So we've got that. Now you can go through the rest of them. There's apparel, there's restaurants, there's all kinds of stuff you could do, and then go to use outside data sources. This is done, by the way. This is not like something new that I'm coming up with. And you put it all together, and you can basically pretty much predict the number there as far as core CPI goes. Anyways, I just thought that'd be cool, something fun to share with you there. Let's take a look at the markets here today. S&P still very much in the downtrend here, and this was the type of rally today. If you were looking around, it was like it was fighting to move higher all day long. It was like somebody was pushing it down, but the market just wouldn't give up. There was a lid on top of the performance, and that lid today came from the bond market. We had rates moving higher on the day, and so that basically put a little bit of a lid on tech stocks. And I'll give you an example. Let's see. Betcha we could do it like this. So I'll go to the intraday chart of Microsoft. I'm just trying to pick a big name, right? So look at what happened throughout the day in Microsoft. We know we need Microsoft higher if we want the market to be really high. We need the big stocks, Apple, Amazon, Tesla, Alphabet, NVIDIA, and Microsoft. We need them to be moving higher consistently because they make up such a large chunk of the market, almost just over 25% now, that if those stocks don't go higher, the market's not going higher. They all tried, but look at Microsoft all day, right? It just, I'm not going to go, I'm not going to go, I'm not going to go. And so that bled over into the markets as well. That's kind of a fun way to look at it that I'm not certain I've shared with you before. You know, it just felt like a stubborn kid not willing to get up out of bed to go to school for the day, right? You know he's going to get there, but it was just kind of a pain there. Nonetheless, the S&P is sitting about just about plus 2% year to date there. And, you know, it doesn't sound impressive, but we're positive year to date, and It's only been 6 trading days in the new year. Keep up this pace, we got a monster year on our hands. I don't think we keep up that pace, but you get what I'm saying there. So don't discount the fact that we're only up 2%. For the year. Add to that volatility has been extremely low as well. We could look at volatility futures over here. We're about to make a new low, I believe. Yeah, almost there. So volatility very, very tight and lower, controlled for the new year. And that's really just because of the way the year started. Remember over here? We finished up the year with next to nothing. We started the year with next to nothing. The action didn't kick off until last Friday there. So there you go. I'd like to point out one thing here for you. If you're curious, I realize sometimes I point out these charts. It's like, yeah, okay, it's one thing I'm looking at. Can I see everything? We can go over and look at the 2023 movers, and then I put them by sector. I'm sorry if it's a little small. Can I do it? You think I could press the button? I'm on my own. Nope, that went over there. Okay, I can't do it. It's not going to make it bigger on the slides page. Yeah, no, okay. That's fine. Big things coming from Cody, by the way. But anyways, here is the biggest movers by sector, both positive and negative. So I'll read them off to you if you're looking here. Basic materials, we talked about Freeport-McMoRan before. Lynn started waking back up there, and BHP Billiton. You've got communication services, T-Mobile, Disney, Comcast, Meta, Notice. Most of them are doing well. Those were the beaten down ones. We'll talk about that in a second. You can look around, kind of see what you got going on. Defensive stocks, Costco and Walmart dominating the way there. A little bit of Philip Morris, but if you were to look at Philip Morris, there we go over here. It's a tough one. Obviously, it's strong. It's holding up. Everything looks pretty good, but you have a bit of a ceiling on the next rally, so it's more maybe like a short-term kind of a trade there. I don't know that I'd be focused on that too much. Healthcare, that's your weak spot for the year so far. Technology, I want you to look down here, up 1.4% so far. That's for the year, so doing well there. You got Taiwan Semiconductors, NVIDIA. We talked about Microsoft already, and ASML. If we go over to the old NASDAQ, nope, that's not the NASDAQ. This one is the NASDAQ right there. It is working its way there. It's the best performer year to date. Doesn't look like it should be, but it's the best performer year to date there, up over 2% for the year. Year to date so far, the laggards have been the leaders, right? We talked about why that was yesterday, but that continues here. So, for example, Amazon leading the way. Obviously very beaten down. Meta leading the way. T-Mobile, just mentioned that a second ago, leading the way. One of the really strong stocks out there. Comcast, we could say the same thing, almost back above the 200-day moving average. Those 5 stocks I just read off there represent half of the NASDAQ 100's year-to-date gains. So we have the NASDAQ 100 up 2%. 1% of all that activity came from those 5 stocks. That's that's saying something, at least. I haven't been able to say a lot of good stuff lately, so I'm happy to say that. The Dow, the weakest of all so far, but still up about 1% year to date. Here's the trouble. You got Salesforce, again, the weaker stocks giving you the early year rally, at least so far. And then Boeing is not necessarily a weak stock, but leading the way there. Those 2 stocks so far have been the biggest contributors for the year in the Dow, but unfortunately, United Healthcare takes away all of their gains. In other words, if you pluck those 3 stocks out of the Dow, it's essentially almost negative for the year. So United Healthcare on a nasty little slide there, very much oversold, very much a contrarian's delight there if you're interested in that sort of stuff. Okay, bonds. Do you buy bonds? Do you not buy bonds? Do you like bonds? Do you want yield? Do you not want yield? What do you want to do here? Let's take a look at something. If we go back, I remember talking about this at the end of 2022, end of 2020, what were your choices for yield if you were not someone who really needed to do anything with the money? It was kind of your safety side of your portfolio. What did you have to do? You either took extremely long-term risk for a net negative return, or you got yourself in the market. Well, people would look at that. I remember having these conversations with people. They're saying, I'll just get in the S&P. I get a 1.5% dividend yield, and maybe there's a chance for growth. Everything's been going really well. How'd that turn out? Very difficult. The trouble is, at the end of 2020, you had no other choice. There was nowhere to go. You couldn't rally any kind of bond ladder program. There's nothing you could do. However, now that's different. Look at the change in the curve, right? It's kind of a fun way to show the yield curve, by the way. Yield curve, and inverted. Basically, you'd call that inverted. Now we have the S&P yielding 1.79, but now you got 1 month notes, 4.13, 3 months, 4.63, and of course the 6 month, it's 4.8. You've got a lot of options here of places you can go for higher yield without stock market level risk. So what happens when everybody decides, yeah, I think I like that, I will go into the bond market? You have volatility back and forth, not to mention the Fed, doing their thing and getting all kinds of crazy over there, but that's what you have going on. So a fun way to take a look at that. All right, a couple more things, and then I got some more data for you. Retail with some excitement here as we get to the end of their earnings. Really, Bed Bath & Beyond did the trick today. Here we go. Lots of good things to say. Well, lots of bad things to say, but hey, that's as bad as it might get, sort of thing. That's how that earnings call kind of went. There was nothing really good said there, besides laying off more people. So stock up 27% today. That had a little bit of a help on the retail space there. If you look at oil, kind of an uneventful day, not much to say there. And if you look at gold, I could say the exact same thing. Gold, there you go, it's coming. It's trending higher, but not much to say in terms of a one-day performance. I got nothing really for you there. All right, let's try a couple things here before we move on. We naturally have a correction here in the stock market. And I wanted to show the returns after a correction versus just any time. So here's what we're going to look at. Here's the median returns of the market in blue following a correction. Even if we went lower, right? So you're going to say, I don't know what a correction is. I bet we went lower. Even if we went lower, if you bought the market after a correction, meaning down over 10% at any point, your median 1-year returns 16.35%. So you always ask yourself when someone gives you a data point, is that better than if I just did the boring old dollar cost averaging, or is it not? So we compared it to any 1-year rolling period. In other words, the black bars that you see there is median 1-year returns. So we take today, go back a year. We take yesterday, go back a year minus a day. Take the day before, go back a year minus 2 days, and so on and so on and so on and so on and so on, right? And just keep layering all that. That's what we mean when we say all other 1-year periods. Any 1-year moment you could be in the market. Now that's interesting. It tells you there's volatility in the short term. There's a reason to be excited about a dip in the market rather than, kind of panic, right? If you're dollar cost averaging, you're like, that's great. I'm going to get outperformance on the shares that I buy during the decline than I would if I just bought them all the time, right? So that's kind of cool. However, 5-year annualized returns after a correction are basically the same. In other words, there's no advantage to saying when the stock market falls more than 10%, I will buy and hold for 1 year. You'd be better off just buying and holding in any random 5-year period. I think I just said 1 year, so I meant 5-year. So in other words, everything I just said, right? Any 5-year window that you want to invest, you're better off just doing it whenever you want to start, even if you pick the worst, right? Over a long enough period of 5-year stretches, you're going to end up with the same return as somebody that picked and chose kind of their starting points based on a correction. That's pretty cool, huh? I don't know. I thought it was cool. I didn't think it was cool. Okay, if you didn't think that's cool, let me cover stocks in the news here, and then I'll have one more thing for you. What's the probability that the market is higher or lower in any given time period? We're going to cover that here in a second. All right, so let's talk about this. Bed Bath & Beyond, already covered it, right? That's the beauty of this. I did it. We don't have to go back, right? I'm the boss. I get to say I don't have to do the work twice. So we got CVS here. They're trying to compete with the others where you have a lot of merging going on here with healthcare providers and these sort of corner drugstores that don't want to be into retail anymore. They want to be a corner drugstore. That's the transition. I don't know how long it's going to take, but eventually you will only go to CVS for things like that. They won't care if you buy a soda while you're there. There'd just be less of an offering there. So they're considering buying Oak Street Health. That's why you saw that one taken off today. Microsoft. There it is. Microsoft is investing $10 billion. That's for real. $10 billion into OpenAI. If you're familiar with the old GPT, that is where that comes from. They have other things as well, but in the social media world right now, ChatGPT is the big focus because it's kind of fun if you've ever played with it. And the more people play with it, the more attention it gets on it, the more it learns. Remember, it's an AI-driven device. So the more it learns, naturally, that means that's good for them. The more they can learn, the more data they have, the more accurate they can be, the more valuable that product becomes to maybe a lawyer that wants to do something quickly, maybe a healthcare provider that's tired of doing things manually and can get AI to do this for them. So good news for them. I believe Elon Musk has his fingers in that as well. I have not looked much beyond just playing with it because it's fun to play with. Crocs. This is kind of fascinating, to be honest with you. This is Crocs. This is the rubber shoes that you wear. And they're killing it. They do really well. Sales growth up 95% over the last 5 years. Margins in the double digits. It's like, what? I just didn't know that many people were interested in Crocs, but apparently going really well for them. And they came out today and said, going forward, our full year guidance, we expect to raise that there. We have sales that will be just as everybody expected, which is higher, of course. So yeah, like good for them. Obviously, it's outperforming everything. I can't say that for Coinbase. Coinbase is going to be eliminating more jobs. The crypto world is sort of going through a rough patch right now. Of course, I don't need to tell you that. Bitcoin around 17.5 today and up 320 points or so. Also, our Jazz After Dark. So Jazz After Dark tonight, we're going to talk about retirement investing for millennials. Get a little bit specific there for you. I got 2 really good tips for you. Last night we talked about saving way too much for retirement and how that, it can be a problem. It's not a bad thing. It could just be a problem. You just have to be willing to accept certain circumstances there. But I don't know anybody that saved too much for retirement and said, I wish I wouldn't have. But I just want to point out some of the pitfalls if you really oversave for retirement. So yeah, check that out. Also on our research site, jazzwealth.com/research. It is a site you can join. It's $13 a month if you'd like to join us there. Going to start loading some more videos because that's more fun, I think, instead of doing more written posts. And yeah, you're free to check it out if you'd like. Let's get on to something really cool here, and then we'll take your questions. If you saw the market go lower, and you said, I don't know, I'm going to get out, right? I'm going to take my cash, I'm going to hold it, and then when things recover or look better, I'm going to get back in. You are essentially making a bet that the market is going to continue lower. That's fair. Every good market, there's a buyer and a seller, so that's okay. There's always got to be somebody on that side. Let's take a look. Over a 1-month period, if you bet for the stock market to be lower, you would have better odds than Mattress Mac had last night for the game. You would have only a 37% chance of the market being lower over 1 month. Doesn't feel like that lately, but those are the long-term odds. Over 3 months, 32% chance. It gets worse the longer you go, I hate to tell you. If you said, I'm taking my money out now, and maybe next year I will come back to the market and I will reinvest. You have taken a bet that is really 75% chance it's going to go against you, and you're not going to be correct. Where would you do that? Where would you ever take a bet like that and say, oh, I got a 24% chance, 24.9? Yeah, I'm going to wait it out for a year. One of the cool things I want to share with you is people that say this is the tip of the iceberg. Oh my God, man, our economy is in for it. We're not going to be able to do things. The global reset, all that fun stuff. And how often has that ever been correct? Now, granted, there could be a time. I give you that. There's always the outlier. But if you said you were going to wait 5 years, you have a 10% chance of being able to buy cheaper than where you got out. I don't like those odds, right? 10 years, 5%, 6%, right? So you've been sitting around for 10 years going, this market's going to crash. You have basically a 6% chance. So I wanted to share that with you. And actually, these are real numbers. Over a 20-year period, there is no chance that you could buy at any price and not have a profit. Over a 30-year period, there's no chance you would be successful at buying less than where the market is. Let's say you started today and then went out 30 years. At least there's never been one of those moments in history. So I thought I would share those odds with you, see how you like that sort of thing. Tomorrow, we only have earnings from KB Homes. Yeah. And I didn't grab the stats on that one. So I'll take your questions if you have any questions, and then we will get on out of the way. See if I can do this here. Try something a little different. We'll just kind of wing it here and see what happens. Yeah. Okay. Let's see if you have any questions, and happy to help. I see you typing a lot over there. You feeling social today?
I was just chatting with the chat for a
Oh,
little bit.
you're just hanging out with the chat? All right. Well, let me get the chat popped up here. I actually can't get it, so we'll hit refresh real quick and do that. Remember, the Jazz After Dark tonight. Come hang out with me. Laid back, right? Just a chilled little spot where we can kind of catch a moment. And I find myself talking faster during those times. No, it's meant to just be hanging out there. If we're not wearing pants, are you at least wearing underwear? Ah, you'll never know. You never know. Asraf says, if I leave my job and I roll my 401k to an IRA, does that affect how much I can contribute to my existing IRA for the year? It does not. Rollovers do not count towards your contributions. So if you rolled over $500,000 to old Jazz Wealth, thank you, we appreciate your business, but then you would still be able to contribute the $6,500 if you're under 50 or the $7,500 if you are over 50 on top of that. So hopefully that specifically answers your question. Yeah. The questioner is, when are you putting a picture of the bear and the bull on the back of the wall of Jazz After Dark? Yeah, it's there. It's always been there. Glad you like it. Yeah. Long-term thoughts on EV. Well, I sort of agree with Barron's the other day. You know, how do you play that with any other company besides Tesla? You know what I mean? Even if you look at some of the bigger names that are the traditional automakers, they're going to lose a lot of money getting ramped up. People forget how much money went into Tesla becoming who they were and how unprofitable it was for a while. So you know the length of time it took for that company, which is largely kind of run like a sole proprietorship, right? So imagine these big corporations that are having to make these decisions. It might take them a little longer. I don't know. I wish them the best, but yeah. Anyways, what do we? Sorry if I missed questions there. Hey, Dustin, real question. Where did you get your info for those percentages in your chart? Versus every analyst and CEO saying recession coming. Which one? And not every analyst or CEO says a recession is coming. There are, you got Goldman, some of Morgan Stanley. I don't know why they do that, but Truist now, all giving less than 35 or less % chance of a recession, which I don't necessarily agree with, because then you're going against all the stats that have never been wrong. So yeah, I don't say I agree with them, but comments from me. If you stop by the Jazz Studio, you put your pants on before you come in. Well, we lock the door for that, right? So if you come by and you try to open the door, it doesn't open, and then it alerts us, and we put our pants on. So yeah, I mean, I'm happy to. Isn't wise to start investing in a Roth 401k at 53 just offered by my employer? Depends on your income and depends on the amount you're going to live in retirement on. The wider that spread is, the less likely it is that a Roth is a good option for you. Yeah. Strength of the yuan versus the dollar. I haven't looked at it, but I know the dollar continues to get weaker generally. That's good news, by the way. It's not American, it's good news. Chris says, wait, rolling over an old 401k to a Roth IRA counts as income, right? Rolling over an old 401k to a Roth IRA, I wouldn't let somebody do that as an initial transaction. Can you do it? Yes, but if you did that, then it still doesn't count towards your contributions, but yes, that would be all taxable and in that event. So you'd have to give me a really good reason why right at the moment that you just happen to be doing a rollover also happens to be the best time to move all of it into a Roth. I can't think of the last time I found where I told somebody, just do it. Yeah, it makes sense. Unless it was like, $500 or something. I get that. Yeah. Fed's increasing interest rates. Why is the yuan beating the dollars? Because China is opening at the moment. Yeah, slowly, but at the moment. Correct. With traditional IRA moving to Roth. Yeah, I think the initial question was I hope it was moving a 401k to an IRA. That kind of a move. I hope I read it right. Yeah. Yeah, nobody's really catching up to Tesla at the moment. There'll be competition. There always is in any space there, but there'll be competition. No, I'm not seeing your question there. Oh, there you go. I see you because you got the purple icon. Covered call on Goodyear Tire. Okay, don't hear that often. So you own the shares. Got your covered call there at 7. No, we got the wrong ticker symbol. What's the ticker symbol? It's not Goodyear. Expiring 2 weeks at $75. Yeah, help me out with that question a little bit. I'll come back to you. I'll be on the lookout for it, but I'm not understanding the ticker symbol there. Are unrealized gains being taxed? No. Unrealized gains are not there. Well, there you go. Yeah. Any thoughts on Dutch Bros? Nope. Kevin, hey, Dustin, if someone put in a lump sum, oh, here we go. Lump sum January 1, 2022, it dropped 30%. Given he has cash on hand, would you recommend a dollar cost average in or wait for a bigger drop? Well, we go two ways with this. So one is that a retirement account and your time frame is becoming limited here? Or if it's just a brokerage account and you put in some money. So those are the two directions that you can go. I would still dollar cost average either way, just because I'm here. I enjoy doing that sort of thing. But if you're a busy type person and you're looking to put the next chunk in or contribution for the year or something, I'm pretty much at that point where I say, okay, down days, I'd at least wait for a really strong down day or next little pullback there. I wouldn't mind. Yeah. And I'm sorry, yeah, if I miss your questions, I don't mean to. It all looks like a blur after 25 minutes. Eloy, so I gotta go, I'll find it. Hold on, let me see. Well, you're way back there. If you post a question during the show part, I know I wouldn't see it. There it is. If I need to trim a large position because hopefully the market goes, if you need to trim a large position, and you have this position split into a taxable and non-taxable account, is it better to sell positions in which account? Well, if you could sell the positions in the non-taxable account, that'd be more ideal. But you're saying you need to trim a large position. If that's because you need the money, that's a different scenario, right? If you're just saying, I got a little heavy in something and I'm happy with it, I would trim it in the non-taxable account first. But it really depends on whether the money needs to come out of the account or not. And sorry, I missed your question there. So sorry. New Jersey and New York. Yeah. Come on down. Come on down to Florida. The only thing we have to complain about here is the stinking property taxes, man. Oh, that one. They came for us this year, man. They really did. My 72-year-old father-in-law asked what a good investment would be at his age. Not sure how much he has. Ooh, too general of a question, and I get in trouble for giving advice publicly to people that I don't know, or, like an example, your in-law there that I wouldn't know. I like it. What else we got? Last couple questions. Which to buy, short-term inflation-protected securities or a bond fund? Well, that's a good question. What's the time frame on that? And compare that to a CD. I know, don't run away. Don't thumbs down me on that one, but they're competitive. Could you compare it to a CD or some kind of a short-term laddered CD process there? Again, I know that's like a bad word lately, but we'll see. All right, I'll wrap it up there before all y'all get mad at me and miss the questions and stuff. I'm sorry. We get like a big projector or something. Or maybe the idea that I give Cody before the start of the show. Just a thought, this is something. Put it out there. Anyways, enjoy the rest of your day, and we'll see you later tonight. Jazz After Dark, come hang out with me. Adios.